fact, it's going to be a busy day for markets this morning. We are expecting a lower opening for the broader averages, and that is after a dismal start to the year. Stocks having an impressive run for the last couple of weeks. The S&P 500 and the Dow Industrials up nearly 15% just since their lows in February. But the story this morning is crude oil tumbling after the meeting in Doha, Qatar, ended without an agreement to freeze production. There is now concern that the Dow's climb to 18,000 may be put on hold as oil prices pull back, down 2 3/4% this morning. Joining us right now with his take is Hirtle Callaghan CEO John Hirtle. John, good to see you. Thank you so much for joining us.
Nice to be here.
Yeah, so oil is obviously one of the issues this morning because we didn't get a production summit cut. Do you think that's going to be and have an impact on markets for a long time?
I don't think so. I think we're going to see it stabilize here. I think this is not that big a surprise. You're seeing a little bit of reaction, but given that oil is substantially higher than it was at its low, it's natural that the producers are going to want to keep pumping. So I don't think this was that much of a surprise. You might have a little bit of a trading bounce this morning, but I think it's more on the stable picture here.
Is that good for the U.S. economy, John?
You know, I think stable, low prices are good. You know, if any kind of dislocation is hard for the energy sector to really deal with. Having said that, the best producers in the energy sector are going to continue to make money. At the end of the year last year, really, for a while, we've been, accumulating these energy producers on weakness. And that looks like it's been a pretty good idea. So, we're all about price. We're chief investment officers, and as a chief investment officer, you're really an asset manager. And our first style point is it's all about price, valuation. And so, interestingly, Brazil, which you've seen do so well lately, was really a price issue. It just got so cheap that it was kind of priced to despair. And so at some price, it's always attractive.
And you think that the emerging markets are actually going to start breaking out here. The morning story, of course, we know that there is a vote to impeach Dilma Rousseff, the president of Brazil. How does that play into this?
Well, that's been anticipated for quite a while, and this is sort of the confirmation of the anticipation. But once again, emerging markets, the key there, I'm not really predicting a breakout. What we're saying is if you're an investor, not a trader, the real cash flow, the price to cash flow, emerging markets look like they're 8 to 10% real, where the United States looks like it's 4 to 5% real over the next 3 to 5 years.
That's an important point. So you're willing to take on some additional volatility to get that extra real return?
Absolutely. And I actually think that's the key issue that everybody's facing right now, these zero real interest rates or negative real interest rates all the way out to 10 years. So the elephant in the room is low returns. So you've got to go to where the returns are. And what I think people don't understand is they've really got two choices as if you're in a broad diversified portfolio. You either have to live with lower returns or you have to accept more volatility because the returns are going to be out in emerging markets and global equities. And that means that the worst thing that can happen is that people commit to this chasing higher returns, normally higher returns, and then checking out when they see volatility and they sell at the bottom. That's the worst. So you really have to understand what you're getting into. Either be conservative and accept low returns or realize you're going to live with higher volatility as you pursue higher returns over the next 3 to 5 years.
So to that point, John, when you look at the emerging markets, so you're talking about allocating some money there. I know we still like the U.S. as kind of the safe haven or the best place to invest. So you're talking about allocating some money there, just to clarify for people at home.
Right. Well, if you look at world market capitalization, emerging markets represent about 8 to 10%. So if you're going to overweight that, you might be 10 to 12. So that's a great point. Having said that, rank order of attractiveness, emerging markets is most attractive. EFA, Europe and Japan, is second, and the United States is third. So the United States is safer, there's no question, but the price is higher. So at the end of the year, the CAPE ratio, which is the cyclically adjusted PE ratio, is 26 for U.S., it was 20 for Japan, 15 for Europe, and about 10 for emerging markets.
So you're telling your investors take a little bit more risk in terms of volatility because you think the real return is there in the long run?
Absolutely. We're trading off volatility risk for price risk. And we think price is the trump card always.
Who's going to be the next president, John?
John Kasich, absolutely.
And
John Kasich.
Is that the best candidate for the markets?
I believe it is, absolutely.
John, good to have you on the program this morning.
So nice to be here.
Thank you so much. John Hirtle joining us there. We will